The Peter Schiff Show.
Today's podcast is sponsored by Indeed. Indeed knows hiring needs to be cost-effective when you're running your own business. Start hiring now with a $75 sponsored job credit to get your jobs more visibility at Indeed.com/Peter. Terms and conditions apply. Today's podcast is also sponsored by Masterclass. Learn from the best to become your best with Masterclass. And right now, our listeners will get an additional 15% off an annual membership at masterclass.com/gold. Welcome, everybody. I am doing this evening's podcast from a hotel room here in South Florida. I'm down here for the Real Estate Guys Summit at Sea, and we're going to be leaving tomorrow for an 8-day cruise. So I'm not going to be able to do another podcast until Sunday night, which is when I will be back in Connecticut from the cruise. I don't want to try to do one from the ship. I'm sure the Wi-Fi is not very good. And so this is going to be the last update that I'm going to be making. Although if anything really big happens, I will be able to comment on it on social media. So if you're not one of my million followers on X, I would suggest that you take the opportunity of following me, because if there is something that I want to comment on, that's probably the way I'm going to do it over the next week. But certainly have a lot to talk about this Friday evening. We had a very busy week, dominated really by the FOMC decision. And between, or on either side rather, of that decision, we had the CPI data that came out on Tuesday or Wednesday. Actually, that was Wednesday morning. That was before we got the Fed announcement that came out Wednesday afternoon. So in the morning, we got the release of the CPI. And then the day after the announcement, we got the PPI. And in fact, we got more inflation data today with the import-export prices. And all of the data was better than expected. Better meaning less. So lower inflation on the retail level, on the wholesale level, and even the import-export prices that came out today were lower than expected. Let me start with the CPI, which was a May number. And the expectation was for an increase of 0.1, which would have been a big improvement over the 0.3 that we got in April. And we ended up getting 0. So no increase at all. That was better than expected. The year-over-year increase in the CPI, which was supposed to be 3.4, came in at 3.3. The core rose 0.2, which was better than the 0.3 that was expected. And the year-over-year core, 3.4, which was better than the 3.5 that was expected, and which lower than the 3.6 from the prior month. And as soon as the numbers came out, gold shot up, the dollar sold off, and everybody was excited because this meant, okay, we have less inflation. That means the Fed can cut rates sooner. But none of this really matters. I mean, this is all a bunch of noise. It doesn't mean anything. Even if we get some better than expected data points in the near term, none of this means that inflation is going down to 2%. It's not going to come anywhere near 2%. Look, we're at 3.3, 3.4 is the year-over-year core. And even if you look at the monthly number, the 0.2% annualizes closer to 3% than 2%. But we are bouncing around the bottom of the inflation numbers. We are headed back up. What the Fed is really looking for is an excuse to do what it needs to do anyway, which is to cut interest rates. In fact, as I mentioned on the last podcast, the Canadian Central Bank, the European Central Bank, they've already cut interest rates, even though inflation remains well above their so-called 2% target. The same thing is true with the U.S. But I think what the Fed is trying to do is to maintain a pretense The Fed wants to fool the markets. That's the game plan, into thinking that they're very vigilant on inflation. So they don't want to fold quickly and cut rates. They want the markets to believe that the Fed is being extra cautious to make sure that by the time they cut rates, that they're confident that inflation is going back down to 2%, because they know they're going to cut rates, not because they've won the battle against inflation, but because they've lost. They have to concede, surrender, but they can't admit that. They need to cut rates because rates are too high for a low, overly leveraged economy to bear. Not just the government, which has a $35 trillion national debt, but corporate America. Is a lot of debt that U.S. corporations took out years ago that is going to be maturing and that needs to be refinanced in 2025 and 2026. And companies can't afford to refinance that debt. Banks are in a lot of trouble because of the mortgage debt that they own and the treasuries that they own. So the Federal Reserve knows that in order to keep this financial house of cards from imploding, it has to cut rates. But it can't cut rates unless it convinces the market that it's already, beaten inflation. It has to create the perception that the rate cuts are justified. And so it has to pretend that it's holding rates at a restrictive level long enough to be certain that inflation is coming down. But all of this is a ruse, because rates are not restrictive. They've never even moved into restrictive territory. I've argued this the entire time. Everything that Powell said during the press conference and in their official statement is wrong with respect to the Fed's commitment to bring inflation back down to 2%. If the Fed really was committed to doing that, it would be increasing interest rates. It wouldn't have stopped hiking them. In fact, if the Fed really cared about inflation, it wouldn't have lowered rates to zero and kept them there as long as they did. Powell mentioned that inflation is creating an economic hardship, which is true. Well, if that is the case, why did the Fed wait so long to raise interest rates? Why did the Fed deliberately allow that hardship to get worse before it took any action? In fact, when the Fed saw that inflation moved above 2%, it didn't immediately raise rates. In fact, it didn't raise rates before inflation got to 2%. The way it's saying it wants to cut rates before it gets down to 2%. See, when inflation was below 2%, the Fed was willing to give inflation a lot of slack. The Fed was reluctant to be preemptive about preventing inflation from rising above 2%. But now it's saying we don't have to wait for inflation to fall below 2%. We can start cutting rates even before it gets to 2%. Well, why didn't it have the same vigilance when inflation was below 2%? Why didn't it raise rates before it got there to make sure it didn't get above? Right? If it really cared about it, it doesn't. The Fed knows that the economy is too over leveraged for a real inflation fight. And so all it could do is have a pretend inflation fight. And now it can't cut rates until it can pretend that it's won that fight. But all of the evidence suggests that they've already lost that fight. In fact, not only did we get the better than expected inflation data that came out this week. And again, we got the PPI numbers. I want to mention those because they came out yesterday. And instead of getting a 0.1% increase in producer prices, we got a 0.2% decline. So this number actually was a bigger beat than the CPI. And on a year-over-year basis, the PPI rose just 2.2% versus expectations of 2.5%. And the core on a month-over-month basis was flat. Year over year, it was up 2.3, which was better than the 2.4 that they had expected. It was better than the 2.4 from the prior year. And in fact, the month-over-month core was supposed to rise by 0.3, right? And instead it was unchanged. So that was even better news. And so the markets would have normally really reacted to this if Powell hadn't taken the wind out of the market sails by not being overly optimistic about this data, because the markets looked at the CPI on Wednesday morning and thought, well, Powell is obviously going to acknowledge this big improvement in inflation and therefore indicate that the rate cuts can start sooner because we've now got this progress on inflation. But instead of accepting this, Powell pushed back by saying we're still not there. We still need more evidence that inflation is really coming down before we can start cutting rates. So the takeaway from the Fed's announcement was that we're going to have to wait even longer to get these rate cuts. Now, the Fed is still indicating that all the cuts are coming. We just may get more of the cuts in 2025 rather than 2024. We may only get one cut in 2024, but don't worry, rates are coming down. They just may come down a little later. And that is really what is driving the market. But again, if Powell really cared about fighting inflation, he wouldn't be signaling any rate cuts at all, because it's obvious from the data that inflation is not going to 2%, that it's more likely to head higher from here than lower because policy never got into restrictive territory. And again, I've explained that on the podcast. The way you know that interest rates were never restrictive is that credit expansion never slowed down. Debt continues to accumulate on the federal level, the government, and on an individual level. Households, corporations continue to borrow money. Leverage, right, in the system is continuing to expand. Household debt at record highs, credit card debt at record highs, corporate debt, government debt. Everybody continues to borrow and spend because interest rates never rose enough to change that, to bend the demand curve. So demand continues to accelerate. And again, even though we saw a decline in the money supply, that decline paled in comparison to the expansion that preceded it. We had this massive expansion in money supply, both before and after COVID, but in particular, during the COVID years, we really grew a money supply that had already ballooned in the preceding years. We've had a small decline, but we didn't go anywhere near where we were before COVID, let alone, before the 2008 financial crisis. So we have massive inflation already baked into this cake. We had a small decline in money supply that has already reversed. Money supply is growing again from an elevated level. And again, with record deficit spending on a federal level, inflation really has nowhere to go but up. And the Fed is ignoring all that and instead is paying attention to these ridiculous official numbers that at best represent looking into the rearview mirror and ignoring everything that should be obvious in the windshield. Anyway, we got a quick break. We got a commercial. We'll be right back.
We're driven by the search for better. But when it comes to hiring, the best way to search for a candidate isn't to search at all. Don't search, match with Indeed. If you need to hire, you need Indeed. Indeed is your matching and hiring platform with over 350 million global monthly visitors, according to Indeed data, and a matching engine that helps you find quality candidates fast. Ditch the busy work. Use Indeed for scheduling, screening, and messages so you can contact with candidates faster. And Indeed doesn't just help you hire faster. 93% of employers agreed. Indeed delivers the highest quality matches compared to other job sites, according to a recent Indeed survey. Leveraging over 140 million qualifications and preferences every day, Indeed's matching engine is constantly learning from your preferences. So the more you use Indeed, the better it gets. Join the 3.5 million businesses worldwide that use Indeed to hire great talent fast. What I love most about Indeed is how simple it makes the hiring process and allows you to do all your hiring in one place. Candidates you invite to apply are 3 times more likely to actually apply for your job than the candidates who see it in search alone, according to US Indeed data. Indeed gets you one step closer to the hire by immediately matching you with quality candidates. And now listeners of my show can get a $75 sponsored job credit to get your jobs more visibility at Indeed.com/Peter. Just go to Indeed.com/Peter right now and support our show by saying you heard about Indeed on this podcast. That's Indeed.com/Peter. Terms and conditions apply. If you need to hire, then you need Indeed.
All right, so while we were getting this weaker than expected inflation data, which again, I think is irrelevant, and I think that we're going to be getting much stronger inflation data in the months ahead. And in fact, even during the press conference, the Fed acknowledged, or Powell rather acknowledged, that the inflation numbers are going to get a little worse before they get better. All right, so if that is the case, why is he still dangling these rate cuts in front of the market? Because if inflation is going to get worse before it gets better, what if it never gets better? What if it just keeps getting worse? And in fact, if the Fed is going to signal that policy is going to ease, if anything, it's going to ensure that that inflation problem that gets worse before it gets better doesn't get better and just continues to get worse. So while we got the weaker than expected inflation numbers, we also got weaker than expected economic data. And that combination really should have sent the dollar falling and gold rising. Gold did rise, but the dollar rose as well. In fact, the dollar index closed out the week very strong. It was back above 105. It looked like it was really starting to weaken the morning prior to the Fed announcement, after we got that lower than expected CPI. But the weak economic data should have really helped. But I think because Powell was not nearly as dovish as the markets had hoped, and also I think there was also some concerns, political concerns building in the Eurozone that helped to cause some dollar buying. But on Thursday, we got the weekly jobless claims, which really spiked up to 242,000 weekly claims. That was the largest number in quite some time, and it was way above the consensus estimate of 222,000 jobs. And the 4-week moving average now moved up to 227,000 jobs. So again, more evidence that the labor market is cracking, despite the positive spin on the jobs data that came out Friday of last week, a week ago. I went over that already, that beneath the surface, and not even deep beneath, just right beneath a very superficial veneer, was a lot of evidence that the labor market is in fact weak. And these weekly jobless claims support that. But also today, we got the consumer confidence numbers that came out much weaker than anticipated. This is consumer sentiment for June. And the consensus was for an improvement in sentiment from 69.1, which is where it was in May, to 73. And instead of going up to 73, the index plunged all the way down to 65.6. That is a massive miss. In fact, the lowest estimate out there was 70. The expectation was 70 to 75. 65.6 is an enormous miss. I think that's the lowest consumer sentiment has been of the entire year. You have to go back to late 2023 to get a number that low. This is really a repudiation of so-called Bidenomics, right? This is, the sentiment of the electorate. This is a huge drop. And in fact, inflation expectations went up from, or actually they didn't go up, they held steady at 3.3%, but the anticipation was for an improvement. And it's high inflation that is part of the reason that consumer sentiment is so low, because prices have moved up so much. And even if the rate of increase diminishes, it's still adding insult to injury, because prices that have already risen a lot are still rising. The rise hasn't stopped, and certainly it hasn't reversed. What the consumer wants is price cuts. The consumer wants some of these price increases to be reversed, but it's not happening. All the Fed is trying to do is slow down the rate of interest. Nobody is talking about reversing the trend and bringing prices back down so that they're not up as much as they are. No, we're just saying we have high prices. We know they're causing a lot of pain. The only relief we can offer is that those high prices rise, but at a slower pace than they've been rising. So we're going to make them even higher. So the consumers obviously are not getting any real relief if prices that are already too high go up even more, right? They need prices to come down. And so that's what you're seeing in the consumer sentiment. But normally, a number this week would have prompted a sell-off in the dollar, a bigger rise in the price of gold, because the markets would have looked at these numbers and said, aha, this is weakness in the economy. The Fed has to do something. But because Powell was more hawkish than expected, I mean, maybe that's not the right way to phrase it. It's not really more hawkish. It's less dovish. That's a better way to describe it, because there's no hawks. I mean, the hawks are extinct. They're like the dodo bird at the Federal Reserve. They're all doves. It's only a question of degree of dovishness. And so Powell wasn't as dovish as the markets had hoped. And I think that is the only reason that we didn't see a bigger reaction to this weaker economic data, both the increase in jobless claims and the decrease in consumer sentiment and the lower inflation numbers that we got. All of that, had it not been for the press conference and what Powell said about, the Fed and how we need even more data, and we're going to wait even longer for these promised rate cuts. If we hadn't had that, then I think you would have seen a bigger reaction in the markets. But I think that reaction is coming, because I don't expect the onslaught of weak economic data to stop. The only thing that has to happen is the job numbers have to turn south. That's the only number that really has remained elevated. And I don't think it's a coincidence. That's a highly politically sensitive number. And so there's a lot of incentive for the government to come out with a strong number. But at some point, there's a limit, I think, to how long a weak labor market can continue to look strong based on these headline non-farm payroll numbers. So at some point, we're going to get a weak number, or the market is going to discount the headline numbers and pay more attention to the incredibly weak numbers that are just beneath the surface. One of the big markets I think that's going to react is the precious metals market. And in fact, what's really interesting about the gold market, because last week, and I talked about that on the podcast, gold was down. Gold was down about 1.7% on the week. And pretty much all of those declines happened in one day. Happened on Friday, when we got the stronger than expected jobs numbers. And prior to that, on the Thursday, gold was positive on the week. We had a big drop. Gold was down like $70, something like that. Silver got clobbered, and gold stocks got obliterated. So if you look at the GDXJ, which is the junior gold miners, that index got beaten up the most. It was down 7% last week. Now, this week, gold made up the entire loss from last week. Gold rose 2% on the week. So between last week and this week, gold was up, and it finished the week strong, up almost $30 today. We closed at 2,334-ish on the day. It wasn't as big an up day as Friday last week was a down day. But because we moved up for most of the week, we ended up recovering all of last week's losses and then some, because between the 2 weeks, gold is actually positive. And the fact that gold was able to rise 2% this week in the face of not only a less dovish Powell, but also a strong dollar. The dollar index got hit pretty hard on the week. Let me pull it up. The dollar index closed at 104.8 last week, and it closed this week at 105.5. So about a 75 basis point move up in the dollar. Yet despite the strength in the dollar, we saw strength in gold. But even though we had that strength in gold and silver, by the way, although silver was not able to recover the $30 mark, it was still up on the week, and it closed at $29.63. I think, great support below 30, and I think silver is a great buy if you can get it below 30. But the interesting thing is that even though gold itself recovered everything that it lost last week, the gold mining stocks didn't recover any of last week's losses. In fact, the GDXJ actually added to last week's losses, not by a lot, but it was still down. So in other words, a 1.75% rise in gold caused a 7% plunge in the GDXJ. Yet an even larger increase in the price of gold didn't result in any increase in the price of gold stocks. Instead, they fell even further. And so what is that telling you? Because gold itself hasn't really gone anywhere. And in fact, it's holding steady at a high price. It just shows you how negative the sentiment is in the mining sector. And I have been pointing this out. This is a massive wall of worry. Even the bulls, even the gold bulls don't believe the market, at least the bulls that are investing in the mining stocks, because they're so scared. When gold goes down, they run for the hills. And when gold goes up, they have no confidence in the rise because they're worried about the next decline. So you didn't see the recovery in the gold stocks to the degree that you saw the carnage when gold was going down. People got so scared. And this, I think, is an extremely bullish factor because you don't have the strong sentiment. It is the ultimate wall of worry. That's why I've been saying that you can buy gold stocks and gold as a contrarian, even though the price is hitting record highs, because nobody believes the rally. We're not that far off from record highs in the price of gold. Yet we've seen a substantial correction in the price of gold stocks, even though we've barely declined in the price of gold. And if you notice what's been happening in gold, it keeps making higher highs and higher lows. Yes, we get corrections when we make new highs, but those corrections don't, go down that far. So the market is consolidating at higher and higher levels as the buyers have to keep paying up to buy gold. And the people who are waiting for a return to lower prices may be looking at a prior low and thinking, okay, let me just try to buy a retest of that low. They don't get it. If you want to buy gold, you have to pay up. You can get a pullback, but the pullback is not going to give you comfort of being a prior low. You have to be willing to pay a higher price to get into this market because it is a bull market. But when it comes to the gold mining stocks, you get plenty of opportunities to buy those cheap because the people buying the gold mining stocks still don't understand how powerful this bull market is, because I think it's being driven in large part by central banks. And as I mentioned, one of the reasons that we got a big drop in gold prices on Friday, it wasn't just in reaction to the stronger than expected non-farm payroll number, but the surprise announcement from China that they took a break and didn't buy gold for a month. And the markets overreacted to that announcement as if the Chinese were done buying. I think that the big buyers of the week were the Chinese. I think the Chinese were able to take advantage of the fact that the market sold off on the news that they weren't buying gold in May to buy a bunch of it in June. And in fact, they're probably going to end up buying more gold in June than they would have bought in May. But because they announced that they didn't buy, they created a sell-off, which they were then able to take advantage of. Now, whether they were smart enough to figure that out in advance, to think, hey, why don't we just stop buying for a month, and then we can tell the markets that we didn't buy, and then the markets will jump to the wrong conclusion that we're done buying, and then we can really step it up. Because I think that the Chinese wanted to back off a little bit. I mean, they've been buying for so many months, and all of a sudden gold spikes up to a record high. It makes sense that they'd want to just back away a little bit and let the market breathe, let it pull back, and then resume their buying. And in fact, as I said in my last podcast, contrary to the way the markets reacted to this news, I think it's very good news that gold made a new high rather, without the Chinese buying. Because a lot of people thought, well, maybe it's only China, right? China's the driver of this rally. They're just one of the buyers, because even though China didn't buy at all, we still made new all-time record highs. And so I took that as a bullish indicator, not a bearish indicator. But one of the reasons I think that you saw such a strong gold market during this past week is because the Chinese resumed their buying. But it's not just the Chinese that are buying. It's all these emerging market central banks that are buying, because they understand what's going to happen with the US dollar. They understand what's going to happen with fiat currencies in general. And so they want to do what they can to diversify their reserves out of paper into real money. And so they're buying gold. And of course, the most over-owned fiat currency, the fiat currency that represents the lion's share of reserves, are US dollars. And so to the extent that foreign central banks are going to buy are going to buy gold, they're going to pay for it disproportionately with US dollars, which is why ultimately the dollar has the most to lose. And in fact, since the dollar just rose against other fiat currencies, that gives the Chinese an even greater incentive to use those dollars to buy gold. Anyway, we got one more commercial, so we'll take that break and I'll be right back.
I've spent my entire career dedicated to learning and mastering my skills in finance and economics. If there's a skill or topic that you want to master, wouldn't it be great to learn from an instructor who has the same dedication in their field? With Masterclass, you won't need to question the quality of your learning. You can be confident in what you're learning. With Masterclass, you can learn from the best to become the best, anytime, anywhere, at your own pace. I'm working with Masterclass, and we have a deal for you. Right now, our listeners will get an additional 15% off an annual membership at masterclass.com/gold. Masterclass is the only streaming platform where you can learn and grow with over 200 of the world's best. For just $10 a month, an annual membership with Masterclass gets you unlimited access to every instructor. And you can access Masterclass on your phone, computer, smart TV, or even in audio mode. Prioritize like a boss with multimedia icon Elaine Welteroth. How to invest in the stock market with Wall Street's best, or build a billion-dollar company with self-made billionaire Mark Cuban. And the classes really make a difference. 88% of members feel that Masterclass has made a positive impact on their lives. Plus, every new membership comes with a 30-day money-back guarantee. Don't wait another moment to start your learning journey with Masterclass. And right now, our listeners will get an additional 15% off an annual membership at masterclass.com/gold. Get 15% off right now at masterclass.com/gold. Masterclass.com/gold.
All right, I'm back. Oh, before I forget, I want to mention too, while I'm going to be on this cruise for a week or so and not doing a podcast until Sunday, not only am I getting the word out through social media, but I also have the new newsletter, Schiff Sovereign. We are putting out information every day for free at Schiff Sovereign. You can go to our website, schiffsovereign.com, and sign up for our free newsletter. If you're not already getting that, you want to make sure and just give us your information so you can get that free newsletter. And if you want to have a the premium newsletter, you can sign up for Schiff Sovereign Premium. Just go to the website under products and you'll see premium. That is the lowest tier. It's only $9 a month to get that newsletter, and it comes with a lot of other perks. If you already are a subscriber to Locals, and if you're listening to this podcast now via Locals and you're not getting the ads, we've already enrolled you in Schiff Sovereign Premium. So you don't have to do anything. You're getting Schiff Sovereign Premium included with your Locals subscription. But going forward, if you want to get Schiff Sovereign Premium, you don't want to sign up at Locals. You want to go directly to the Schiff Sovereign website. We're going to be, phasing out Locals, and we're going to be offering all of those services via Schiff Sovereign Premium. But the people who are already signed up are getting it, and they're getting the benefit of a lower price because they're not having to pay the $9. I think it was $5 a month for Locals. So we're just kind of grandfathering the people who had already signed up for that product into this new product. But there's going to be a lot more value that people are going to be getting for their subscription to Schiff Sovereign Premium. So just go to the website again, schiffsovereign.com. If you just want the free newsletter, you can sign up for that. But if you want to be a premium member, you can also enroll there. And again, it's $9 a month. If you're not happy after the first month, you can just cancel your subscription and you are going to get a full refund. So there really is no risk to giving it a try. Anyway, so while actual gold was having a positive week, 2% increase in the price of gold, I think fool's gold, Bitcoin, was actually headed the other way. It was probably down, I don't know, it was like 3-4% on the week. As I am recording this podcast, Bitcoin is trading just below 66,000 per Bitcoin. It was above 71,500, I think, just a few days ago. And I think the real hype that has been driving Bitcoin has been now the reality that Ethereum is now going to also have an ETF, and the markets had taken that as a positive. I don't look at it as a positive. I just look at it as another competitor for the Bitcoin ETF. So I think it's just another problem that's on the horizon. But also you have the decoupling again of Bitcoin from the NASDAQ, because the NASDAQ has continued to make new all-time record highs. In fact, the NASDAQ hit another all-time record high today, even as the broader markets continue to move lower. The Dow Jones is 38,300. It hit a record high a couple of weeks ago above 40,000. So we've seen a bit of a correction in the Dow, but we've seen a new record high in the NASDAQ. In fact, we also had a new record high, although not today, but earlier in the week. In fact, I think yesterday, we had a new all-time record high in the S&P 500. Now, the reason the S&P 500 made a new record high and not the Dow was because of the technology that's part of the S&P 500. Of course, all of this is being driven by AI, NVIDIA. Again, another new all-time record high. The stock did a big split, which is why the share price closed at 131.88. I think it was a 10-for-1 split. I mean, a huge split, which adds no real value to the company. You just have, more shares, but it's more slices of the same pie. So you don't eat any more pie, right? You just have more bites. But speculators have generally been encouraged to buy stocks when they split. And so this obviously has continued. But NVIDIA just up again. Also, though, we had a huge move up in Apple stock, not today, but during the week. Apple rose sharply to make a new all-time record highs, although part of that had to do with their announcement of their AI strategy. So AI fueling demand for Apple, because I guess people think that people are going to want to buy more Apple products. They're going to want to upgrade to the iPhone 15 because that one is going to be compatible with their new AI products, which I think older models will not. And maybe it will cause people to upgrade some of their other Apple products that will now be compatible with Apple Intelligence, which they're working on. But it's this AI theme that continues to drive this narrow group of stocks to move higher and higher and higher, which masks the underlying weakness in a lot of other stocks. Because remember, the indexes are market cap weighted. So as these huge companies make new highs, that has a disproportionate impact on the overall level of the index, which creates the illusion that, oh, we've got this huge bull market, the indexes are making new highs, but those highs are all because of a smaller and smaller group of stocks. They refer to that as the breadth of the market, and the breadth is getting narrower and narrower and narrower as fewer stocks are contributing to the gains in the overall index, whereas the majority of the stocks are going down. It's like the troops are not following the generals, right? And the generals, there's fewer and fewer of them. And, I guess when they used to call the generals, because it was like General Electric, General Motors, but those aren't even the generals anymore. The generals are NVIDIA or Microsoft or Meta, right? Or now Apple. Those are the generals in this war. But the troops are just way in the back. And so it's masking, a kind of a stealth bear market that's going on because stocks are overpriced and they're in a lot of trouble. Again, one of the reasons too that U.S. companies are in a lot of trouble is because they have a lot of debt. We have not really seen the full consequence of a return to 5% interest rates after living in a world of 0% interest rates for so long. And that is because a lot of the debt, and I mentioned this a little bit earlier, but I want to expand on that point, but a lot of the debt that was taken out when interest rates were at zero, a lot of that debt hasn't had time yet to roll over, to mature. Now, some of it has, certainly. Some of the debt that was taken out in 2016 or 17 or 18, some of that debt has matured in 2023 and 2024, but a lot of that debt has yet to mature. But a lot of that is going to happen in the years ahead. And as more of that debt matures and has to be rolled over, it's going to be a bigger and bigger problem in the economy, especially for some of these highly leveraged companies that were selling high yield bonds, which junk bonds. But the yields on those bonds were historically low in a 0% interest rate environment. But now a lot of those companies are looking at yields in the double digits if they are able to roll this debt over. So this is a huge ticking time bomb that the Fed doesn't want going off, right? And again, it's not just corporate America that is going to see a huge increase in their debt service costs. The U.S. government is already seeing that. That's why interest on the national debt is over $1 trillion a year. And that's why it will be over $2 trillion a year at the end of next year, unless the Fed cuts rates, which is why they're going to do it. It's also why the Fed is going to go back to quantitative easing, because they have no politically viable alternative to doing that. They're just now trying to, to lay a foundation to be able to cut rates, to be able to go back to QE while still pretending that they've remained vigilant on inflation and that they won a war that they clearly lost. And in fact, I wanted to mention this when it comes to companies issuing debt. MicroStrategy, again yesterday, announced that it's going to borrow another $500 million to buy more Bitcoin, right? How much Bitcoin is MicroStrategy going to buy? And you would think they have enough, that they don't have to borrow money to buy more. I think one of the main reasons that Michael Saylor continues to borrow money to buy up Bitcoin is to prop up the price. That's why he's buying. He's the biggest holder. And in order to keep the price from going down, he has to keep buying more. But he doesn't have the cash to buy more, because MicroStrategy as a company doesn't earn enough money to keep buying Bitcoin. So the only way that MicroStrategy can keep buying Bitcoin is to borrow the money. And so the lenders have to be willing to extend the credit. Now, eventually, this whole thing is going to dry up. I mean, I think this is a sign of desperation. And people are like, oh, this just shows how much confidence he has in Bitcoin. No, it shows how desperate he is to prop up the price, that he has to keep on going deeper into debt. I mean, no responsible CEO would be doing this. In fact, no responsible CEO would have bought Bitcoin in the first place. But I can understand, or I can't even understand it, but it's one thing to take your cash and use it to buy Bitcoin. It's another thing to go into debt, to borrow money, and then to use that money to buy Bitcoin. Bitcoin is not a productive asset. When a company borrows money, it needs to borrow money to invest in productive assets. Normally, it would be productive assets that make the company itself more productive. So I need to buy some more equipment that will generate more earnings. So if I can borrow money as a corporation, and let's say I borrow money and my interest cost is 8%. But if by borrowing money at 8% and then using that money to invest in plant and equipment that will increase the productivity of the business so that the extra income that is generated by the investment exceeds the cost of borrowing the money. Okay, well, then it makes sense. I can borrow money at 8%, and then I can grow my earnings by 12% or 15%. Well, that is a productive use of debt, because then I can take the extra earnings, right? Because I borrowed this money and I invested in plant and equipment, I can take the extra earnings and pay off the debt, right? So that makes sense. What doesn't make sense is to borrow money to gamble on Bitcoin, because the Bitcoin itself is generating no return by which the interest can be paid, let alone the principal retired. It is pure gambling, right? You don't invest in a company so that the company can go gamble with your money. Although apparently that's why people buy MicroStrategy, is so Saylor can lever them up and buy Bitcoin. Because I guess everybody who owns MicroStrategy by now knows it's no longer a business. It's a leverage bet on Bitcoin. And I guess Saylor thinks, well, the more leverage we have, the more attractive MicroStrategy becomes as a speculative bet on Bitcoin. But the less attractive and less viable it becomes as an actual business. And the more likely it is that eventual business goes into bankruptcy, which I have been saying for a long time is the only way this MicroStrategy show is going to end. Because Saylor is going to borrow money until he can't borrow anymore. And that's going to happen because nobody will lend, because the whole Bitcoin bubble has crashed. But between now and then, he's going to keep on buying. The fact is, he's buying, and we haven't even had that big a correction yet from the highs, right? The highest we got in Bitcoin was what, 73,000, something like that. So we're only down at 65 and change, and he's already in there buying. I mean, this is a high price. Imagine how desperate Saylor's going to be to try to prop up the price of Bitcoin when it goes down to 50,000 or 40,000. He's going to have to back up the truck if he can even afford to borrow the money to get the truck to try to buy more. So I think he's going to be buying all the way down. And the fact that he even buys the highs, to me, shows that without that buying, and I think that, yes, these ETFs came in and provided a lot of new buying into the market. But if you listen to all this rhetoric now about Bitcoin, it's the institutional buying that's supposed to be driving the move to new highs. In fact, everybody keeps coming out with these price targets on Bitcoin: 200,000, 500,000, a million. And one of the reasons I think Wall Street keeps coming out with these optimistic pie in the sky targets is because they're all getting in on the action now. You have all these firms that have these ETFs. Well, they have to keep driving demand for Bitcoin because they make money based on the assets under management. I mean, they don't really have to do much managing, and they don't even have any real assets. They're charging real fees to manage fake assets. but they have to encourage more and more buyers. So they have to keep coming out with these price targets on how high Bitcoin is going to go so that more people will buy into these ETFs. But there is a big difference between the ETF buyers and the individual buyers who were driving the market before the ETFs existed. Remember, a lot of the people who were buying Bitcoin never intended to sell their Bitcoin, right? The true Bitcoin maxis, they are waiting for hyper Bitcoinization. And if you've never heard that term before, what hyper Bitcoinization is when the whole world basically adopts Bitcoin as money, as currency. And so that's what the Bitcoin hodlers are waiting for. They're not waiting to sell their Bitcoin. They're waiting to use their Bitcoin when everybody else is using it as a medium of exchange. That's why, in their mind, it doesn't matter what the Bitcoin is worth in dollars because they're never going to sell for dollars. They keep saying, well, one Bitcoin is always worth one Bitcoin. And the reason that matters is if you believe that eventually the whole world is going to be on a Bitcoin standard and your wealth is going to be a function of how many Bitcoin you have, then you're never selling. And it doesn't matter to you what the price is if you believe that eventually, if you want food, you're going to need Bitcoin because that's what the grocery stores are going to be accepting, right? Everything you're going to buy, you're going to be able to buy it with Bitcoin. In fact, if you don't have Bitcoin, you won't be able to buy it because that's the only currency anybody is going to want, right? That's what people believe. Well, the people who are buying the Bitcoin ETFs, they don't believe this at all. If they believe that, they would have already bought Bitcoin in the spot market. The Bitcoin ETF buyers are just pure gamblers. They're buying Bitcoin to sell Bitcoin. They're buying these ETFs to sell them. The same thing for any asset manager who's managing a hedge fund or who's managing somebody's money. To the extent that they added a Bitcoin ETF, they're going to sell that ETF. It is a trade. They're buying it to sell it. They're not buying it to use it as money. In fact, they can't use it as money because it's locked up in an ETF. So the fact that the market is now so dependent on institutions buying ETFs, that's not a good sign. That is a bad sign because that means it's not future buying that you're going to get, it's future selling. Right? Because I think the lion's share of the ETF buying, that's already happened. Right? I don't think there's a lot of money out there that wants to buy the ETFs who hasn't done it yet. I mean, the people who want to buy, they bought. I mean, the ETFs are here, right? They had an explosion of demand. The money went in. Now what's left is for the money that went in to come out. The problem is it can't come out, right? It's like a Roach Motel, right? I use that analogy a lot, but it is very fitting when it comes to these Bitcoin ETFs. The money can check in, but it can't check out because the only reason that people were able to buy these ETFs is because you had plenty of people in the spot market who are willing to supply the Bitcoin that the ETFs were demanding, right? That's where it came from. Why isn't Bitcoin already at 100,000, right, with all these ETFs? Why is it no higher than it was 3 years ago? I mean, Bitcoin, again, is 66,000 right now. It was 69,000 in 2001 without any ETFs. So with all these ETFs, with all this leverage buying from Michael Saylor, with all the buying from other companies that have now come around and levered up or put Bitcoin, with El Salvador making it legal tender and buying it, why is Bitcoin not higher than it was in 2021? Because somebody sold, right? There was some big selling of Bitcoin to enable all these new people to get in. Somebody got out. And in fact, that's why they encouraged all the buying, because the people who got in a long time ago needed an exit strategy. They needed a buyer to sell to, and they cultivated these buyers. But what's going to happen when the guys who own these Bitcoin ETFs, when they want to get out? Who's going to buy the Bitcoin there? There won't be no buyers. They're the suckers. They're the bag holders. It's whatever institutions or individual investors were dumb enough to buy what Wall Street sold them, they're left with a bill of goods, because when they want to sell, when they want to cash out these ETFs, either because they want to take profits or they want to cut their losses and move on to another trade, there is no big buyer left in the cash market. The big buyers were in the ETF markets. They're going to be the big sellers. And the large whales, or that's redundant, the whales who sold their Bitcoin to these ETFs, the last thing they want to do is buy it back, right? They probably have more that they're still trying to unload. And so when the ETF buyers become sellers, look out. This is going to be a massive collapse. So you still have an opportunity, hodlers, while Bitcoin is around 66,000 and gold is still now below 2,400, around 2,330. This is a great time to exchange your fool's gold for real's gold. Anyway, that's it for today's podcast. Again, remember, anything that happens over the next week, make sure and follow me on X. That's where I am my most prolific as far as trying to communicate with my followers. Again, you can also follow me at Schiff Sovereign by signing up for our free newsletter, or one better, become a premium member. In the meantime, don't forget, if you like today's podcast, give me a thumbs up, give it a like, throw a comment or two. In fact, I may be replying to some of these comments while I'm on the cruise, because that is, doesn't require that big an internet connection just to post some comments. So I could communicate with you that way. Anyway, that's it for today. And I'm looking forward to seeing whoever signed up on this cruise with the cruise. We do have some people who signed up who are fans of the Peter Schiff Show podcast. And by the way, one of the things that we're going to be doing with Schiff Sovereign is more events, meetings that we'll have. And many of those will be exclusive events for Schiff Sovereign members. So that's another reason to sign up. Anyway, bye for now.